Have you ever wondered how to build a diversified investment portfolio? Want to know more? Diversification in the world of investing is crucial. It's akin to not putting all your eggs in one basket. By spreading investments across various asset classes, you cushion the potential risks associated with a single asset. It's a strategy that can help weather financial storms, ensuring your portfolio thrives in various market conditions. So, how do you build a diversified investment portfolio? Stay tuned to find out. To start, you must understand the different asset classes available for investment. First, we have stocks, essentially shares in a company. They offer high potential returns but come with a substantial risk. Then there are bonds, essentially loans to a government or corporation. These offer lower potential returns but are generally considered safer than stocks. Next, there's commodities. These are physical assets like gold, oil, or coffee. The risk and return of commodities can vary greatly. Real estate, on the other hand, involves investing in physical property. It's often seen as a hedge against inflation, but comes with its own unique set of risks. Lastly, we have cash equivalents. These are the safest asset class, offering low returns but very little risk. Think of things like savings accounts or treasury bills. Now that you have an understanding of different asset classes, it's time to delve into the process of building a diversified portfolio. Building a diversified portfolio isn't as complicated as it sounds. It's all about balance. Our first step in this journey is to assess your risk tolerance. This isn't a guessing game, but rather a thoughtful examination of your financial situation and your emotional capacity to withstand potential losses. Are you a cautious investor who prefers stable returns, or a daring one who doesn't mind a bit of a roller coaster ride for the potential of higher gains? Understanding your risk tolerance is crucial because it guides the composition of your portfolio. Once we've determined your risk tolerance, we move on to determining your investment goals. What are you investing for? A dream house, retirement, or perhaps your child's education? Your goals will determine the timeline of your investments. If your goal is short-term, you might be more inclined to safer assets, while long-term goals may allow more room for higher risk, higher return investments. Now, armed with knowledge about your risk tolerance and goals, we get to the heart of the matter: asset allocation. This is where diversification truly comes into play. The aim is to spread your investments across various asset classes like stocks, bonds, real estate, or even commodities. The exact mix will depend on your risk tolerance and investment goals. For instance, a risk-averse investor might lean towards bonds, while a risk-tolerant one might tilt more towards stocks. The key is not to put all your eggs in one basket. Finally, we arrive at the step of reviewing and rebalancing your portfolio. This isn't a set it and forget it scenario. The financial market is a dynamic beast, and your portfolio needs to adapt to keep pace. Regularly reviewing your investments ensures they still align with your goals, and rebalancing helps maintain the desired level of risk. Remember, diversification is not a one-time event. It's an ongoing process that requires regular attention and adjustment. So keep your eyes on the ball and let your portfolio work its magic. So let's recap what we've learned about building a diversified investment portfolio. The essence of diversification is not putting all your eggs in one basket. It's about spreading your investments across various asset classes such as equities, bonds, commodities, and real estate to mitigate risk. Each asset class provides a unique blend of risk and return, and the right mix depends on your financial goals, risk tolerance, and investment horizon. We've understood that different asset classes have diverse risk and return profiles. Equities, for instance, offer higher potential returns but come with increased volatility. Bonds, on the other hand, offer more stability but often yield lower returns. Commodities and real estate provide an effective hedge against inflation and diversify your exposure beyond traditional securities. Building your portfolio step by step requires patience and discipline. Start by setting clear financial goals, then understand your risk tolerance and decide on an asset allocation strategy that aligns with your goals and risk profile. Regularly review and rebalance your portfolio to ensure it remains aligned with your strategy. Remember, investing is a marathon, not a sprint. It's about being consistent and patient, not reacting to short-term market fluctuations. It's not about timing the market, but time in the market that counts. Building a diversified investment portfolio may seem daunting, but with knowledge and discipline, you can manage your investments and achieve your financial goals. Remember, it's not about timing the market, but time in the market that counts. Thank you for watching and happy investing.